Vigilant Asset Allocation, VAA, is a rules-based investment strategy built around momentum, but with a twist. Instead of protecting you by trend following each asset one by one, it looks at the whole market universe and asks, how many assets are breaking down right now? If too many are weakening, VAA moves a big chunk, or even all, of the portfolio into a defensive cash sleeve made of bonds. The paper's core idea is simple. Be aggressive when conditions are healthy and get defensive fast when breadth deteriorates. VAA sits in the dual momentum family. Dual momentum combines two ideas. First is absolute momentum. An asset is good if its momentum is positive and bad if momentum is 0 or below. Second is relative momentum. Among the good assets, you prefer the strongest performers. Think top-ranked assets. Most dual momentum systems use absolute momentum at the individual asset level as crash protection. VAA does something more vigilant. It uses breadth, the count of bad assets across the whole universe, to decide how much to de-risk. The paper uses a specific fast momentum calculation called 13612W. It blends performance over the last 1, 3, 6, and 12 months, but importantly, it weights recent movement more heavily, so it reacts faster than classic 12-month momentum. In plain English, recent price action matters a lot, which means VAA can shift risk quickly when markets change character. The authors apply the same momentum filter for both absolute and relative momentum to keep the logic consistent. Here's the key mechanism. Each month, VAA counts how many assets in your risky universe have non-positive momentum. Call that number B. Then you choose a protection threshold, B. If only a few assets are weak, VAA may stay mostly invested. As more assets turn weak, VAA increases its defensive allocation. And if weakness hits the threshold, B greater than or equal to B, VAA goes fully defensive. So instead of asking, is my current holding in a downtrend? VAA asks, is weakness spreading across the opportunity set? That's breadth momentum. A practical issue, if the cash fraction changes a little, you'd normally have to scale every position up or down, more trading. So the authors propose easy trading, ET. You choose a number T, meaning you hold the top T assets, ranked by momentum, equally. Then, instead of partially reducing everything, VAA rounds the defensive shift so you replace risky holdings one slot at a time. Example intuition. If T equals 3, the portfolio moves in 33% steps. One risky position can be swapped out for the defensive asset, then 2, then all 3. In VAA, cash doesn't have to mean sitting in a zero-yield money market. The paper uses a small cash universe, bond-like assets, and each month it picks the single best one by momentum. In their shorter global tests, that cash universe includes bond ETFs, similar to short treasuries, intermediate treasuries, and investment-grade corporates. In the longer US historical tests, they use bond indices representing T-bills, intermediate government bonds, and long-term corporates. Important detail, VAA does not require the cash asset's momentum to be positive. It simply picks the strongest defensive option available. Here's VAA as a clean monthly checklist. 1. At month end, compute 13612W momentum for each risky asset in your universe. 2. Label assets good if momentum is positive, bad if momentum is 0 or negative. 3. Count B, the number of bad risky assets. 4. Use your chosen B to decide how defensive to get, translated into a cash fraction. With easy trading, that fraction is rounded into chunks, so implementation is simpler. 5. From the risky universe, rank assets by momentum and by the top T, equally weighted using the non-cash portion. 6. For the cash portion, rank the cash universe bonds by momentum and hold the best one. Then repeat monthly. That's it. Monthly ranking plus breadth-based defense plus a momentum-selected bond sleeve. The authors judge performance mainly by CAGR and maximum drawdown because drawdowns are what investors feel most. They also report Sharpe ratio, but measured versus their cash universe return MAR ratio, which is return divided by max drawdown, and a new measure called RAD, returns adjusted for drawdowns, designed to heavily penalize large drawdowns, especially beyond 50%. So the strategy isn't trying to win a volatility beauty contest. It's trying to avoid deep equity-style crashes while still producing equity-like growth. Now the numbers people care about. How did it do out of sample in the paper? The authors test 4 universes, 2 global and 2 US, and they choose parameters in an in-sample period, then evaluate results in an out-of-sample period. Out-of-sample highlights reported in the paper. Table 17. VAA global 12, N equals 12, T equals 2, B equals 4, CAGR 10.5%, max drawdown 13.0%, Sharp 0.51, MAR 0.81, RAD 8.9%, average cash fraction about 59%, transaction costs about 1.4% per year as modeled, VAA global 4, N equals 4, T equals 1, B equals 1, CAGR 16.0%, max drawdown 10.4%, Sharp 0.92, MAR 1.54, RAD 14.1%, average cash fraction about 57%, modeled transaction costs approximately 1.3% per year, VAA-US 15, N equals 15, T equals 4, B equals 3, CAGR 11.7%, max drawdown 12.1%, Sharp 0.57, MAR 0.96, RAD 10.1%, average cash fraction about 61%, transaction costs approximately 1.4% per year, VAA-US 6, N equals 6, T equals 6, B equals 1, CAGR 10.8%, max drawdown 12.0%, Sharp 0.48, MAR 0.90, RAD 9.3%, average cash fraction about 58%, transaction costs approximately 1.2% per year. The theme is consistent, a lot of time in defensive assets, often more than half the time, yet still maintaining double-digit growth with relatively contained drawdowns in those tests. What makes VAA different is the mindset. It's not just hold winners, it's watch the entire field, and when weakness spreads, step aside aggressively. The trade-off is clear in the paper's own stats. You may be defensive a lot, and turnover plus transaction costs matter, but the design goal is also clear. Try to avoid the worst parts of major drawdowns and let compounding work from a smaller hole. Everything here comes directly from Keller and Keuning's 2017 paper on SSRN, and if you want to implement it, the cleanest starting point is the monthly rule set. Rank, count breadth, size cash fraction, hold top T, pick best bond for the defensive sleeve, rebalance monthly.